I would now like to review exercise 19-17, and we will be building on information that we used to calculate basic earnings per share in exercise 19-16. We are now going to calculate the basic earnings per share, but also the diluted earnings per share. Diluted earnings per share, in the calculation, we can consider the potential number of shares that could be outstanding. For example, stock options could be exercised. They may not be exercised in any year, but we will include them as potential shares outstanding and treat that as if it happened in the beginning of the year, unless we know it happened at a specific date within the year. The only time we would use diluted earnings per share would be after we considered the potential shares outstanding. If the diluted earnings per share was less than the basic earnings per share, we would not show that on the financial statements. So let's look at exercise 17. This is a variation of 19-16. On December 31st, 2020, Berklayer Inc. had 200 million shares of common stock and 3 million shares of 9% $100 par value cumulative preferred stock issued and outstanding. On March 1st, Berklayer purchased 24 million shares of its common stock as treasury stock. Berklayer issued a 5% stock dividend. On July 1st, 2021, 4 million treasury stocks were sold on October 1st, and net income was $150 million. Also outstanding on December 31st was 30 million incentive stock options granted to key executives. On September 13th, 2016, the options were exercised as of September 13th, 2020, for 30 million common shares at an exercise price of $56 per share. During 2021, the market price of common shares were $70 per share. Compute Berklayer's basic and diluted earnings per share for December 31st. The basic earnings per share would be the $150 million minus the 27 million preferred dividends paid to calculate net income available to common shareholders, and that would be the 9% of $100, which is $9, times 3 million preferred cumulative dividends. So our numerator would be 123 million. They had 200 million shares at the beginning of the year. They purchased their own dividends. They purchased their own stock for treasury stock for 24 million on March 1st. There was a 5% dividend declared in July 1st. And then they also sold $4 million of the treasury stock in October that were purchased in March 1st. So, since we know there was a stock dividend on July 1st, we go back to the beginning of the year to the date the dividend was declared, and we recalculate the number of the shares outstanding and the weighted average of shares outstanding, including the 5% dividend. So this would be 200 million times 1.05. So we would have 210 million shares outstanding at the beginning of the year. On March 1st, they purchased their own common stock, which is treasury stock, and that would be a subtraction of stock outstanding. So it would be 24 million times the number of months left in the year, which would be 10 divided by 12 times the 1.05. So that would be a subtraction of $21 million. And then the 4 million shares they sold from the treasury stock that they purchased in March would be 4 times 3 divided by 12. We don't have to include the stock dividend because it happened after the dividend was declared. This actually happened on October 1st. So the weighted shares outstanding for common stock is 190 million. So the earnings per share is 65 cents. Now for diluted, we consider all potential shares that are outstanding. And they told us as of December 31st, all 30 million incentive stock options granted to the key employees on September 13th, 2019. They were all outstanding. They have not been exercised. So that is the only potential shares that could be outstanding. And we assume that happened at the beginning of the year. And you know how they started out with the weighted shares of 210,000 or 210 million. It's the 200,000 times 1.05 for the stock dividend. The treasury stock they purchased their own common shares would be the 24 times 10 divided by 12, which would times 105, which means you would subtract 21 million. And then they purchased 4 million, they sold 4 million shares from the treasury stocks they purchased for 4 million times 3 divided by 12, which is 1. Now the assumption is they gave us the assumption that all stock options were outstanding for the entire year of 2021. So to actually calculate what is outstanding for stock options, what the assumption is, they take the money they received when the shareholders that had the stock options assume they exercise them at the beginning of the year, and then they take their money. So if there was 30 million stock options outstanding and the executives only had to pay $56 to buy those $30 million of shares, that would give the company $1,680,000. And if you divide that by the average market price is $70, they would really have purchased $24 million. They would only have the cash from the exercise of the stock options. They would only have enough cash to actually purchase $24 million of their shares, which would be treasury shares. This is known as the treasury stock method. They take the proceeds for the exercise of the stock options, which is 30 million shares that were outstanding all year, times the exercise price of $56. That's what they're going to receive from the employees. So they have $1,680,000. They're going to take that money and repurchase the stock at the average price of $70 million, but they can only buy 24 million shares. So you would take the 30 million, actually assuming the stock option occurred at the beginning of the year, you would take the 30 million shares less the purchase back of their own shares, the treasury stock method, of 24 million. So the assumed exercise of options is 6 million shares. So if you take 210 minus 21 plus the 1 million and the assumed option, the exercise of the stock options on January 1 for 196 million shares outstanding. So it would be the 123 million divided by the 196 million. So their diluted earnings per share is 63 cents. We compare that to the 65 cents for the basic, and yet it meets the criteria that the fully diluted must be less than the basic earnings per share calculation, and that would be reported on the financial statements as the earnings per share. Under this method, for stock options, you take the cash you receive, you assume the options are being exercised as the beginning of the year, you take the cash you receive, and the assumption is you would buy back shares at the market price. So that's why you have to use 30 options, or 30 million shares would be issued, but they would purchase back 24 million at the market price. So the potential outstanding would be $6 million for the entire year.